Ladies and gentlemen, good day and welcome to the 9-month and Q3 earnings call of M&B Engineering Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this call is being recorded. I now hand the conference over to Krishna Patel from EY. Thank you, and over to you.
Thank you, Yashashvi, and good evening, everyone. Welcome you all to M&B Engineering Limited Q3 9-month FY26 earnings conference call. To take us through the results and to answer your questions, we have with us the management of M&B Engineering, represented by Mr. Chirag Patel, Joint Managing Director, Mr. Malav Patel, Joint Managing Director, Mr. Sanjay Majumdar, Director, and Mr. Keyur Shah, the Chief Financial Officer. Please note that the discussions that we may have today may contain certain forward-looking statements relating to the future events, future performance. Numerous factors could cause actual results to differ materially from those in the forward-looking statements. Please note the audio of this earnings call is the copyright material of M&B Engineering, cannot be copied, rebroadcasted, attributed in press media without specific written consent of the company. Now, I would like to hand over the call to Mr. Malav Patel, the Joint MD, for his opening comments. Thank you, and over to you, sir.
Thank you, Krishna, for the introduction. Good evening, everyone, and welcome to the earnings conference call of M&B Engineering Limited to discuss our performance for the third quarter and 9 months ended December 2025. It has been a strong period for the company, and I'm pleased to share the highlights with you today. I trust you have reviewed our financial results and the investor presentation available on the stock exchanges and on our website. I will first cover the key financials and operating highlights for the quarter and 9 months period, and then outline developments across our Phoenix and Proflex division, along with our outlook. Let me begin with the financial performance. I am delighted to report that M&B Engineering has delivered its highest ever quarterly and 9-month revenues. During Q3 FY26, revenue from operations stood at 352 crore, a healthy 7% year-on-year growth. For the 9 months period ended December 2025, revenue rose to 896 crores, reflecting a very strong 33% year-on-year growth and underscoring the momentum in our business. Our international business continues to scale well. Consolidated export sales during Q3 FY26 were 63.17 crore, and exports for the 9-month period stood at 119.95 crore, demonstrating sustained traction in overseas market and with North America as the key growth driver. Our visibility on future growth remains robust. As of 31st December 2025, the unexecuted order book stood at rupees 1,059 crore, up by 38% year-on-year. Of this, the Proflex division accounts for 23%, which is 240 crores, while the Phoenix division constitutes 77%, standing at 818 crore. Within the Phoenix order book, export orders contribute rupees 316 crores, highlighting the growing contribution of high-value international projects. Order inflows during Q3 FY26 were particularly encouraging at rupees 480 crores, marking an 86% year-on-year increase. This sharp growth in order intake reflects strong demand, higher win rates, and our ability to convert our pipeline into firm orders. Our execution track record remains a key strength. The Phoenix division, with over 15 years of operation, has completed more than 1,600 projects and installed over 6.9 lakh metric tons to date. The Proflex division, with a 23-year history, has executed over 8,400 projects and installed more than 19.9 million square meters. This scale, coupled with consistent delivery, has helped us build deep, long-lasting relationships with customers across sectors and geographies. Let me now turn to our international strategy and capacity platform. Our Sanand PEB plant is currently the only facility in India with the AISC certification, a prerequisite for most general contractors in the United States. Combined with a dedicated marketing setup in the eastern US and the credibility we have built by supplying pre-engineered buildings and structural steel for large-scale industrial buildings, this gives us a clear early mover advantage in a very large and attractive market. While sector-specific duties are currently weighing on margins, returns from this market still remain comfortably ahead of the domestic Indian market. The recently announced trade deal between India and the US, which reduces reciprocal tariffs, is a positive structural development and should, over time, improve sentiment and support more competitive economics, even though the specific sectoral duties are yet to change. We are also actively leveraging the CWB approval obtained for our Sanand plant, which is mandatory for exports to Canada. This positions us to deepen our presence across North America. In parallel, we have initiated the approval process for our Sanand plant for entry into the EU market. The recently concluded trade understandings between India and the EU should help us fast-track our access into that region. During Q3 FY26, we secured the single largest export order to date, valued at rupees 212 crores from the United States. This is a strong endorsement of our engineering capabilities, reliability, and competitiveness on a global stage. While we remain extremely positive about the long-term opportunity in the Indian market, we will continue to expand our geographic reach. Our strengthening international franchise is expected to structurally improve our margin profile and allow us to benefit from both domestic and global growth cycles. During 9-month FY26, we incurred capital expenditure of rupees 12 crores, primarily towards augmentation and operational strengthening. These investments are calibrated to our medium-term growth plan and are focused on enhancing throughput, efficiency, and delivery timelines. Let me briefly highlight the developments in the Propex division. Our new unit sourced from the UAE was received in December 2025 and is commissioned in January 2026. The remaining 2 units from the US are expected to be commissioned in Q1 of FY27. Once fully operational, these additions will increase Proflex's installed capacity by approximately 3 lakh square meters per annum, positioning the division to capture incremental demand and further improve service level to our customers. Coming to our guidance, we remain confident of delivering our FY26 outlook. We expect the top line to be around 1,250 crores, with EBITDA margin in the vicinity of 12.75%, supported by a strong Q4 across the domestic and export markets. Looking ahead to FY 2027, we see a solid foundation for continued growth. We expect to carry an unbilled export order book of approximately anywhere between 280 and 300 crores at the end of FY 2026, to be built in FY 2027 alongside additional PEB and Proflex capacities that will be added available for a major part of the year. We will be in a better position to provide more specific guidance for FY 2027 at the time of our Q4 FY26 result call. In summary, M&B Engineering is entering its next phase of growth with 3 clear levers: a healthy and a diversified order book, proven execution capabilities backed by decades of experience, and targeted investments that are expanding our capacity and global reach. We remain focused on disciplined execution, profitable growth, and value creation for all our stakeholders. With this, I would now like to hand over the call to our CFO, Mr. Keyur Shah, to take you through the detailed financial performance of the company. Over to you.
Thank you, Malavi, and good evening, everyone. A warm welcome to the earnings conference call of M&B Engineering Limited. I shall summarize the consolidated financial highlights for the quarter and 9 months ending on 31st December 2025. Let me begin with the key highlights for the quarter ended December 2025. During the quarter, revenue from operations was at 352 crores with a growth of 7% from 328 crores in quarter 3 of FY25. During the quarter, EBITDA was at 44 crores, a healthy growth of 30% from 34 crores in Q3 of FY25. EBITDA margin was at 12.4% as compared to 10.2% in quarter 3 of financial year 25. During the quarter, PAT was at 25 crore, a growth of 44% from 18 crore in Q3 of FY25. Now, let me take you through the performance for the 9 months ended December 2025. During 9 months of financial year 26, the company recorded a revenue of 896 crore, a growth of 33% from 675 crore in 9 months period of FY25. During 9 month period of FY26, the company recorded EBITDA of 114 crore, a growth of 26% from 91 crore in 9 months period of FY25. EBITDA margin was at 12.77% as compared to 13.5% in 9 months of FY25. During 9 months of FY26, the company recorded PAT of 66 crore, a growth of 35% from 49 crore in 9 months of FY25. PAT margin was at 7.3% as compared to 7.2% in 9 months of FY25. During 9 months of FY26, the company recorded export revenue of 120 crore, up by 107% Y-on-Y basis. Out of the total net IPO proceeds of 259.32 crore, company has utilized 130.31 crore so far. That is 50% of the funds have been utilized as on 31st December 2025. During the quarter, 2.77 crore was utilized. That concludes with my update on the financial highlights of the company. I shall now request the moderator to open the floor for question and answer session. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take our first question from the line of Gaurav Shukla from Finvestors. Please go ahead.
Good evening, sir. Congratulations for good set of numbers.
Gaurav, may I request you to use your handset mode, please? Your audio is not very clear.
Am I audible?
Yeah.
Yes, please go ahead.
Good evening, sir. Good evening, sir. Congratulations for good set of numbers.
Yes, thank you.
Sir, just I want to ask about FY27 growth rate. In which respect, I want to say that Phoenix mode or Proflex mode. Which sector should be grow in FY27?
Well, Gaurav, obviously, as Malav said in his opening speech, we have an unexecuted order book of almost 280 to 300 crores which will be built. We have about 20,000 tons of additional capacity coming in Sanand. And then obviously, Proflex maybe, we have 3 lines which will be fully operational. Why we think that a little more precise guidance we need, because there are a few more orders which are under negotiation and in pipeline. But you can definitely expect a very sound, higher teen growth. But this is more as an indication. We will be more specific definitely by end of Q4.
Okay, sir. And sir, new unit, I have heard that new unit in UAE. Sir, please throw some light on that.
JR unit, you mean to say?
New unit, yes.
Yes, what would you like to know about that?
Only one.
What is your question?
Sir, you have said in opening remarks that a new unit is established in UAE.
Yes.
No, we bought a new unit for Proflex from UAE. We are not setting up a new unit in UAE. It's equipment that we bought for Proflex business from UAE.
It is a manufacturing equipment that we have bought, one from UAE and 2 we have ordered from the United States. The one from the UAE has already been commissioned in January of 2026, and the 2 additional manufacturing units which we are importing from the US shall be commissioned in Q1 of FY27.
Thank you. Before we take the next question, we would like to remind participants to ask a question, please press star and 1 on your phone. Next question is from the line of Aniket Madhwani from Step Trade Capital. Please go ahead.
Yeah, hello sir, I'm audible.
Yes.
Okay. I just wanted to clarification on the capacity expansion. You were adding around 20,000 tons per annum at Sanand and 28,000 tons per annum at CR. So is it operational as of now or?
No. So as we clarified, Sanand plant expansion is underway. We have already started doing all the work required, and we are targeting to make it operationalized by Q2 of FY27. Chair plant expansion we will immediately take up thereafter, so that it becomes operational in somewhere around Q1 or Q2 of FY28. This is the plan.
Okay. After the Sanand plant gets operational, you will start expanding at CR.
Because the chair we have started only before a year actually. So chair is a brand new facility where we are working on building up the capacity utilization to its optimum level, which we feel should come next.
Okay. So in FY27, what level of utilization you will be achieving, I mean, at both facilities?
See, existing Sanand overall existing utilization between both the facilities is on an average around 65 to 70%.
Sanand is 75.
Sanand is 75 plus. Sanand is absolutely choco-block. Chair is nearing 50%, but chair will pick up in the coming quarter. So next year, chair should become
70%.
around 70-75%. And then the new capacity, of course, it takes a little time. But that new capacity, once it comes in, obviously, we should be able to ramp it up quickly in terms of utilization. But अभी मान के चलो next year average about 65-70% utilization overall.
Overall, it will be around 65 to 70%.
Yeah.
Okay, good, got it. And in Q3, what volume did we achieve in Phoenix and Proflex segment?
Volume, yes. Okay, please.
Here, 1 minute.
Snapshot. Yes, Minta.
380,000 square meter, that is in Proflex. Okay, vis-a-vis 343,000 in Q3 of previous year.
346,000.
380,000 this quarter.
And in Sanand, which is in tonnage,
Total.
in Phoenix, it is in tonnage, which is 20,228 ton, vis-a-vis 19,362 of previous year quarter 3.
9 months tonnage भी बोल दो.
If you want 9 months, I can give you 9 months figure. 10,68,000 square meter in Proflex, vis-a-vis 8,27,000 square meter of previous year 9 months. And in Phoenix, 51,908 metric ton for this year 9 months, vis-a-vis 38,811 metric ton for the previous year 9 months figure. 51,908 vis-a-vis 38,811. Okay.
Got it. And regarding margins, when are you expecting to stabilize around 15%? I mean, still we have achieved around 11% in this quarter for operating margins, if I see.
So, we, I think what Malav clearly said, that this year's target was around 12.75% or thereabout, and we are on track. You see, in a given particular quarter, what happens, the dispatches happens as per the dispatch schedule and the project completion schedule of the customer. So, a particular quarter sales mix may not be optimum. We are requesting you that in our line of business, a quarter to quarter की जगह आप annual देखेंगे. So therefore, by implication, fourth quarter will be much stronger because there are some very good orders which are going to be executed with a very decent
Better
higher
price.
margin.
Better price.
So overall around 12.75 to 13. Now if you see today in US, which is our major market, although there is a tariff reduction on the overall reciprocal regime, the sectoral remains. So unless I think that next year also around easily around 13% or little higher could be a good measure, but as we say, they are not giving any guidance for next year, but currently आप ये range में पकड़ के चलो.
Got it.
Thank you. Thank you. Aniket, I request you to join back the queue, please, as we have other participants waiting for their turn.
Sure, no worries.
Thank you. The next question is from the line of Hitesh from Abacus Asset Managers. Please go ahead.
Yeah. I just want to confirm on the domestic side, our revenues have declined by roughly 10% on a YOY basis. Would that number be correct?
Can you get back with the question, please? You got disconnected in between.
Hitesh, please use your handset mode.
Yeah, I'm on handset. I'm just saying on the domestic side, our revenues have declined 10% on a YOY basis. Is that number broadly correct?
Yeah, because export has increased.
Domestic, you are talking of total के division wise. I think totally exports have gone up. Capacity limitation was there in Sanand. So whatever we had to push first in exports, that is used. But overall domestic order book is very, very strong.
Yes. And see, in order book, we have to always take care of the capacity, because we cannot book the order which are beyond our capacity, and because our orders are to the tune of say 9 months cycle. So if we know that within that 9 months this order is not going to be serviced, we should not take that order. So we always have to be selective in the order booking. And as and when we have booked the capacity, we have to wait for the further business.
See, basically,
Shouldn't we have utilized the Chennai, Tamil Nadu facility?
The thing is, see, Hitesh, I'll explain you better. Right, as we speak, only my Sanand facility has the required certification, correct? And that capacity is not enhanced yet. Next Q2 of next year, that capacity will be enhanced by 20,000 tons. That's what we've communicated, right? So I have to balance between my domestic and export output from that limited 72,000 tons of Sanand capacity which is currently existing. So if my export execution is higher, then it will have to be compromising, we will be compromising on the domestic output. So that's how that balance will always remain, but it may keep shifting on a quarter-on-quarter basis because my capacity, additional capacity is not in place yet.
And one more thing I would like to add one more thing. Say if you look at my three months figure, I have gotten a growth of 57%, whereas domestic also I have got a growth of 46%. So it is not like numbers are totally different. 46 vis-a-vis overall 57, and the 9 months figure we have achieved 33% overall growth, whereas my domestic has grown by 27%. So it is hand in hand. Only thing is we have to
keep shuffling between domestic and export.
Available capacity.
Right.
No, I understand that. I totally understand that. My only point was that couldn't we have used the Tamil Nadu facility where our capacity utilizations are lower, as you said? Couldn't we have used that in this quarter?
Yeah. So, Chirag here, see, if I have a job in, say, north of India or west of India, it would not be feasible to ship out the material from the Chennai plant. So for Chennai, it is not that I can ship a job that is going on in north of India, right? Because of the transport cost. So that, though our order book for north and west is high and the approval of projects have come through, that doesn't mean that I can ship those projects from Cheyyar facility. So we limit to about 800 to 1000 kilometers what can be addressed from the southern plant. or chair
Sure.
plant.
Thank you.
Thank you. Next question is from the line of Aditya Soma from Ambit Wealth PMS. Please go ahead.
Yeah. Hello, sir. Am I audible?
Yes, yes.
Yeah. So hello and congratulations on a great set of results. So what I'm saying is, if you look at exports, right, exports was close to 10% of revenue in FY25. It is for this quarter close to 20%. When we look at the total order book, it's close to 30%, and in terms of order inflow, it's close to 50%. So what is the guidance going forward in terms of like order book from exports? And secondly, in terms of after the reduction in tariffs, what can we expect in terms of margin?
See, going ahead also, the export market remains robust, as I spoke in my speech. As we speak, there is a good pipeline of inquiries from the US and the Canadian market. So, the inflow will continue. The quantum of size or the size of projects may vary, but we are quite confident about the order inflow that will be coming in the current quarter as well as Q1 of 27, right? Secondly, about the tariff का जो अभी reduction हुआ है, that is mainly in the reciprocal, which is product specific tariffs, right? Which is different between different countries. India पे 50% था, उसमें 25% was the reciprocal tariff and 25% was the penalty for using the Russian oil. So what has been reduced is this 50% to 18%, but it's product specific. Where we fall is the sectoral tariff, which is on iron, steel and copper, which is flat on the entire world, whatever country is exporting into the US market. So that remains intact at 50%. There is no change in the tariff that is applied to businesses like us in the steel sector, right? But this reduction in the reciprocal tariff will definitely end up or result into a positive sentiment in India as well as in the US. So, you know, the investment cycle will also go up in the US. That will indirectly bring us a larger scope of business in the coming time. So the current tariff reduction does not directly affect our business in the US. It remains at the same level.
Sure. So, and secondly, I wanted to know, are we looking at an AISC and CWB certification for the chair plant as well in the short to medium term?
AISC, we are initiating in anytime in this quarter for the chair plant. CWB, we will keep specific to the Sanand plant.
Sure. And last question from my end. So, if you look at one of our peers is planning to raise a QIP to, you know, front load a lot of capex because of the kind of demand that they are seeing. So, are we looking at kind of investing more in terms of capex or front loading some of the capex, maybe through any means of financing?
So no, I'll tell you, I know what you are getting at, but see, currently we have about 120 crores capex pending out of the IPO proceeds, so we are focused on that first. Secondly, we are increasing our overall capacity by 40,000 tons, as you are aware. 20,000
yes.
will come in 27 and another 20,000 in 28. So our long-term strategy is to definitely look at in India a third plant. We are evaluating various options, but at this point in time, while absolutely we are clear that we'll have to put incremental capex in India, there is no such plan or no such thought that comes to our mind that we might need additional capital. If I have to borrow, I have enough propensity to borrow, but will not be, thinking of any such thing like QIP, etc. But yes, capex definitely we are very clearly evaluating the third plant option.
Okay. Sure, sir.
So in the southern part of the country.
In the southern part? Northern part. Yeah, that makes sense.
South mein to hai bhai.
Yes. Yeah, that's it from my side, sir. Thank you.
Thank you.
Thank you. Next question is from the line of Vaibhav Shah from Equirus Securities. Please go ahead.
Yeah, thank you very much for the opportunity, sir. The pre-tariff price arbitrage between our and local US supplier was somewhere around 1,200 USD, which was narrowed down to USD 400, 500. So now with the reduction of this reciprocal tariff, what kind of price arbitrage improvement we are expecting?
Yeah. So, as Malav just explained, we are part of sectoral tariff, which is aluminum, steel, and copper, and there is no reduction. So the arbitrage on the pricing remains the same. If this sectoral tariff gets reduced or any variation comes, we will see at that time. But currently, we are at the same level which we were in Q3 as well as our Q2.
Okay. Secondly, sir, you have previously guided for the capex of rupees 650 million for FY26, but with the 9-month FY26 capex of rupees 120 million, now what kind of capex do you envisage for full year FY26 as well as FY27?
See, whatever we have guided is first phase under the IPO, which is Sanand, then which is under progress, as per the schedule. We want to conclude this, and it will be operational within, say, end of the Q1 or early Q2 of the next year. So this capex will take place. This is related to my first phase of Sanand plant, 20,000 capacity expansion under the IPO.
So to be a little more specific, about 60 odd crore would be for the Sanand expansion. 12 crores is spent because IPO has happened only in the August, right? We have placed orders, civil construction is undergoing. Major part of the capex will happen in Q3 and something, Q4 and something in Q1.
Major in Q1.
So major in Q1, sorry, my mistake. Major in Q1. Exact figure I will ask you to work out, but another 15 to 20 crores will go in the Q4, and then rest 30 to 40 crores will come next year out of phase 1. Phase 2 bhi chalu ho jayega. We expect the total capex to be in the range of about 80 crores next year.
Okay, got it. And lastly, sir, in the Phoenix segment, could you give some sense on the realization? So how does it look like for the current outstanding order book, that is for both domestic and exports? So like in FY25, the domestic realization was around 1,10,000 rupees and exports would be somewhere around 2.5 lakh rupees. So how does it look like for our current outstanding order book for both domestic and exports?
Yeah, Vaibhav, based on the current order book for domestic and exports, the range would remain the same. For the sales price range will remain the same, 110 broadly, yeah, 110 for local and about 250,000 for international.
But it's not directly comparable, Vaibhav. So in international, there is a lot of element of bought outs. So from project to project, bought outs can be different. And then today, as a DDP, delivered price, also the tariff part has been added.
Yeah.
So, we add tariff on the sales price, and then tariff becomes the direct cost also to that extent. So, I would say that it can vary on international from project to project. Domestic may be, this is a product kind of pricing. There would be an element of erection and implementation services which can add another about 15 to 20 rupees per kilo on the domestic side.
Understood, sir. Understood. Thank you very much for answering my questions, sir. I will get back in the queue.
Thank you. We'll take our next question from the line of Asim from DAM Capital. Please go ahead.
Hi, good evening. So I had a couple of questions on the domestic PEB business. So first of all, can you just tell me what was the domestic order book for PEB as of Q2 end and what is it now as of Q3?
835.
Yeah. Q2 end was 930 crores of the order book, which were bifurcated between 230 odd crores was Proflex, 122 crores from export. And the remaining was in domestic, right? Now currently the breakup is like 1059 is shared by 240 crores by Proflex, 818 by Phoenix, which is further broke down like 316 crore export and balance in domestic. So domestic also there is good numbers, and as well as export has increased.
Sorry, what was the Proflex number for Q3? 240 crores, right?
240.
240 crore.
240.
Okay, so the numbers for the domestic PEB order book would be 580 odd crores as of Q2, 500 crores as of Q3. So about a 80 crore drop in orders. But I was just seeing your domestic PEB revenue booking. I think that has increased from 190 to 220. So basically the incremental revenue QOQ is 30 crores, but the domestic order book number is down 80 crores. So just can you help me understand what I'm missing here?
When we book an order, we book our capacity to execute that order also, right? So if I have booked an order, which is the big one, 212 crore export, right? So a part of my capacity I would have allocated for that order, and therefore during that time my domestic order obviously will go down. My intake has to go down because I will not be able to service that. So we keep on continuously see our capacity availability versus capacity booked and free capacity. Now, if you see here, we have already declared two decent sized jobs for domestic. Both are domestic, and the domestic pipeline is also very good. And those two jobs we have already declared, which are about 110 crores in value, and a good amount of pipeline is also there. So based on my availability of capacity allocation and the location of the job, this number will vary from time to time, quarter to quarter.
But there is no such directional conclusion that there is some reduction on the domestic order flow. In fact, the pipeline is very solid, even on the domestic front, and we are struggling. To be very honest, some of it might be required to be outsourced as well. That is the situation.
So I think you're consciously, given the capacity constraint, you're consciously focusing more on exports, reducing your focus on domestic, even if it is temporary, right? So that is the broad understanding from what you just said and to an earlier question as well.
No.
It's a conscious effort.
No, it's not like that. As I said, for example, my Sanand I have 6,000 tons, right, per month. Now, if I allocated to this international job, say 2,000 per month for say 3 months, for say example is a 6,000 ton job. So then I only have a remaining part of the capacity that I can allocate to the domestic job. So as I said, we clearly foresee well ahead in time that what is my capacity availability and the capacity that I can allocate to different jobs. So as we said, that it will differ from time to time based on the capacity allocation that we have done from both the plants.
Sure, I understand that. There's just a limited point that I was trying to think about is that, given that your listed peers are being more aggressive in the domestic market, I just hope we don't lose market share just because you're prioritizing exports given your capacity constraint.
No. It is not a conscious effort, neither it is that case we are prioritizing it. It is, we have to weigh many factors when we are tagging or choosing a certain project. It is based on the prestige of the project, the customer, long-term relationship. So there's many factors which will drive and govern our decision on which order to take and which not. So it will continuously be shifting within a quarter as well as quarter to quarter. So there is no conscious effort, neither there is any prioritizing.
No, but Asim, I will add one thing which is very important. We are not under pressure to take any job at any margin just to fill up the capacity. We have this luxury of having a very strong exposure to good margin giving markets also. So margin is one of the important criteria rather than just going for growth in terms of top line. Having said that, please understand we are looking at the third facility in India. Probably we are going to expedite its announcement as soon as we are able to have some location. So India remains absolutely on top priority. Having said that, a little bit of conscious effort towards maintaining a decent margin is more important rather than only top line for the sake of growth. If I have to summarize our strategy, then this is what it is.
Understood, sir. Thank you. Thank you very much for answering my questions.
Yeah.
Thank you. Next question is from the line of Vinit Mehta from Ashika Group. Please go ahead.
Hello. Am I audible?
Yes.
Yes.
So, I was looking at your cost of materials as a percentage of sales across last 8 quarters, and it is quite volatile. I assume the main cost is steel. So, can you help me with what type of steel is there? Like, it is going in cost of material? Why this huge swings from year on year and quarter on quarter for cost of materials?
Yeah. So, see, cost of material, when you look at PEB consists of various parts like primary, secondary, sheeting and all. So, each part has a different cost factor. So, in annual things, everything is boiled down to average, and because most of the jobs gets closed during the start and close during the year, so it gets average out. But each component has a different cost component attached to it. So whatever material has been used, accordingly the cost applies. Second thing is when we do export is also having a factor of US buyout. And US buyout is a very
volatile.
Very value-wise very big item. So whenever this takes place, delivery of US buyout takes place, that also increases my COGS.
So overall, rather than seeing for a quarter, it would be better to see for a for a 9-month or a 6-month kind of a longer period. So which will then if you see that, then the COGS will almost remain within the range.
But from a pure production point of view, I would say we are working in the gross margin region of around 32, 33, 34%. That is the gross margin in terms of a pure sales minus RMC at the production.
Okay, got it. And secondly, most of the players in this PEB industry are looking for Canada market. Like, you see a lot of growth from Canada market? Like, have you started getting orders from Canada market, or you are waiting for some certification over there? I assume you have the certification.
We already have the Canadian Welding Bureau certification. Our Sanand plant is certified by this authority. As we have communicated earlier, the CWB certification is mandatory to supply any building materials into the Canadian market, right? As we understand right now, Phoenix Sanand is the only plant which is certified by CWB. If there is any recent development, then we need to investigate on that. But since we got this CWB certification in June, I think May or June of 2025, we have received about 5 orders, executed about 3, and 2 are underway.
So going forward, let's say that between US and Canada, like, is there Canada more beneficial to US, like being the capacity being limited at Sanand? So will you cater to more Canadian market or US market? Can you give color on that?
I think I'm sure the US would be leading because it's a much larger market, right? And we have been present in the US market since more than 5 years now, and we have a good coverage of the geographical areas in the US. It's larger than Canada as of now because see, AISC certificate I've had since 2020. CWB का भी last year ही आया. So we will be slowly adding the Canadian presence. But right now, as we speak on the eastern seaboard, especially on the Southeast American markets, we already have a good number of marketing people. We have a good, reasonable size of network of general contractors. So US will always be leading as far as North American business goes, even in the coming time.
And like tariffs won't impact, like no more higher realization in Canada because of tariffs or something, or Canada also has tariff for India?
Yeah, Canada has tariff. I think it is 25%, but the pricing is better than the US, and my margins are better than US. But Canada also is as a growth for Canadian market. They are also facing this tariff that major produce is going into the US market, right? Because they are also having tariff, and they are also their industrial growth or the growth of exports from Canada to US might suffer because of the tariff, and therefore obviously Canada will grow for us, meaning there is still a good opportunity, but it will not be as big as US because US is a very, very big market.
And well established.
And better established for us, and we will be expanding in the next year as well, geographically in the US.
That's great, sir. Congratulations on great set of numbers. That is from my side.
Thank you.
Thank you. We'll take our next question from the line of Somil Mehta from Kotak Mutual Fund. Please go ahead.
Yeah. Thanks for the opportunity. First, two questions from my side. Given the near-term capacity constraints, which I'm sure will be rectified in the foreseeable future, any new orders, what you're going to bid, is it fair to assume that they will be at a higher single-digit margin or double-digit margins, given we'll have to be very judicial in terms of what kind of orders we want to take? It is purely in the near term.
Yes. See, Saumil, as Sanjay Bhai rightly said earlier, our endeavor is always on the bottom line, right? We work towards getting the right projects which will serve my business objective, and one of the major objectives is serving the bottom line and the growth in the bottom line. And today we are in a fortunate position that our order book is of at that stage wherein we can command our price, right? So obviously that is going to be our focus in the coming time. We may be a little bit more picky in the coming months when it comes to order intake.
Sure. Second question, Chirag Bhai, is why not have all the export approvals given at the Cheyyar plant? I understand Sanand has all the approvals. Cheyyar has few of them, but going forward, how should we look at approvals even for the South India plant?
No, so as from Cheyyar, we are starting with AISC because my presence in US is much higher currently. And as earlier discussed during the call, that we will then start, once I have the Cheyyar facility been approved, I'll start my sales and marketing activity on the west coast of the US, where my shipment from the Pacific route will happen to the western market. The Sanand is going through the Atlantic route, which will help the eastern and the southeastern markets that we are currently operating. Canada major market is on the eastern seaboard, right? In the center and on the west coast of Canada, there are not large industrial units. The major industrial units are based out of the eastern part of the Canadian market. So currently, we are targeting CWB only for Sanand, and going forward, if we see that demand is picking up, we will obviously take it. It is not that much of an issue, and we will obviously take up for the Cheyyar. But AISC, we have already started, and we should be getting the approvals later this year, and probably Q2 or Q3 of this year.
Okay, and sure. And my last question, in terms of, there was news flow that railways is going to at least shut down all the crossings and eventually any update over there, any preliminary indication, any thoughts over there? Because that seems to be a very large opportunity, which obviously we have built in the capacity, but it is not translating into the revenues which we had earlier envisaged. I mean, obviously things are beyond our control, but what is the thought process over there and where are we?
So you rightly said, railways, the railway underbridge, which are called RUBs, about 11,000 rural RUBs are going to be converted in the coming maybe 5 to 10 years, with an average size of about 1,500 square meters, which will relate to a TAM of about 1.65 lakh square meters, 1.65 crore square meters, right? There are many workshops for Vande Bharat, many rail yards, many stations that are going to convert it. But as we know that once the approval comes from railways for a certain project, it takes time for the civil work, it takes time for the execution. So total addressable market only for railways for this RUBs, the Vande Bharat depots, the line sheds, that we are seeing at between 2 crore square meters to around 2.25 crore square meters, a huge opportunity. And for all these areas, our product has been approved. So going forward, there will be good amount of conversion that will happen, and good amount of order intake will happen from the railways.
So Karan bhai, just to add, typically it takes a much longer time. So this opportunity we are talking of potentially over a period of maybe next 5 years. It doesn't happen overnight. Railways take time, but that opportunity is now becoming very, very clear, and it is, I think, progressing well. Yes.
No, fair point. My only question was, maybe the opportunity was always there. What I want to understand is 3 quarters back, the kind of interaction levels and the interest which was there from the railways, is it at similar levels or things are moving at a much advanced stage is what I wanted to understand.
No, they are at similar. If I tell you, currently my railway related inquiry is anywhere between 5 lakh to 5.5 lakh square meters across all the zones. There are about 19 zones in Indian Railways. Across all the zones, these are the pending live inquiries that we are having. And because it is self-supported roofing system that has already been a part of the inquiry and a part of the design, this will get converted to the orders in the coming time. This will come through EPC contractors to us.
Got it. Okay, sir. Thank you so much and all the best for subsequent quarters.
Thank you.
Thank you. Next question is from the line of Hitesh from Abacus Asset Managers. Please go ahead.
Thanks. Sir, on a sequential basis, our share of exports is largely same. It's around 22% or marginally higher. But our gross margins are significantly down by 3-4%. How do we explain that? Did we make less margin in exports in this quarter?
See, basically, of course, the hit of tariff on the sectoral has suppressed our margin to an extent. See, as a business call, the stage at which Phoenix is in the US market, it is more important for the company to retain and or grow the customer base, right? That is my top priority at the stage at which I am today. For that to happen, I have to absorb some extent of the tariff while I am able to give a competitive price to the US customer, right? So the US customer has to find my commercial offer of at least a certain advantage to him to be able to ship from a US manufacturer to an Indian supplier, right? So while focusing on expanding the customer base, it is a give and take situation, right? I have to absorb a little bit of a tariff to make my price attractive enough for a US consumer. So that's how this reduction or suppression is coming in the margin. That is true.
So I think you're right. Sequentially, this particular quarter, whatever exports were made, bulk of them were at a lower margin in the sense that the product mix or the sales mix, Q4 we have a lot of dispatches at a much better margin. So what happens over a period of 1 year or 6 months, margins normalize. So you are right. Sequentially, we'll have a better margin in Q4, 100%.
Okay, sir. Best wishes. Thank you.
Yeah.
Thank you. We'll take our next question from the line of Shashi Karthik from Brighter Mind Equity Advisors. Please go ahead.
Hello. Hello.
Yes, we can hear you. Please go ahead.
Okay. Good afternoon. Thank you for giving the opportunity. The first question is, in which geography we are seeing more, development in terms of growth, pan-India?
You mean to say which region?
Yeah, which region in India, domestic market?
Domestic, as I earlier said, for our pre-engineered building business, the sweet spot is 800 to 1000 kilometers. So my Sanand plant is able to cater to the north and northwest, the central west, central, and the west, which is Gujarat, which is our major market. Then south is able to deliver to the 3 or 4 southern states. East and a part of north, probably UP, western UP, and those projects will not be viable to be shipped out from Phoenix, both the plants. So currently, as I said, west would be the strongest region for us.
Okay. As we are seeing lots of development in southern part of India in terms of semiconductor setup, or in northern India in terms of electronics market setup apart from South India. So are we serving these markets? As you mentioned, north is Uttar Pradesh is quite distant from your plant. So are we looking at the southern part? Tamil Nadu, and where we are actively engaged?
Yes. One of the reasons behind putting up a manufacturing unit in Tamil Nadu was to be able to have a physical presence and be in close connect or a vicinity with the potential customers, right? From Tamil Nadu, we can very efficiently and economically supply and deliver our projects to the customers in all the 4 southern states, which is Andhra Pradesh, Tamil Nadu, Telangana, and Karnataka. So Tamil Nadu is one of the, southern regions are one of the potential regions where we see a lot of long-term growth for the business we are in.
So therefore, as we earlier said, so our third plant will be in the North India, nearer to probably Lucknow, Western UP, Central UP or towards Eastern UP, which we can cater to the northern market as well as the East market and UP area. So that is how our Phoenix business is there. Proflex, we are okay to take orders across India. So we concentrate across all the states except the 7 eastern states and probably Kashmir and the northern Jammu Kashmir and those areas. Other than that, our presence is there across all the states.
Okay, that's very pleasant to hear. Apart from that, which industries we are seeing incremental demands building up apart from renewable energy sector?
Industry, currently we are seeing a good demand from the automotive. We have also given, there are live inquiries from large data centers, which I will not be able to divulge the name. We also have currently got sizable order from a defense company in the domestic market.
International defense company.
International defense company in the international market, in the domestic market. So we are seeing positive traction for coming out of data center, electronic EMS manufacturing,
renewable energy
and renewable energy.
Yeah.
And semiconductor projects that are happening largely by Tata in Dholera. Some inquiries are going on, so we'll be able to convert it into orders in coming times.
Okay. So, what about the current competitive intensity in the industry, as many players are building their capacities and obviously doing some fundraise to front load the capacities and all?
The competition, yeah, because the demand is quite robust. Competition will be there, and a lot of people are setting up their plants. But our almost now 2 decades of experience, the execution of the projects, the deliverable of our projects to our long customers and the repeat clientele is going to help us, though the competition is there, and there would be enough work for everyone. So competitive pressure will be there, but there is enough work for everyone.
And newer application areas for steel constructions are coming in as we speak, right? Earlier, a couple of years back, the data centers which a couple of companies set up were made out of concrete, like conventional construction methodology, right? Now what investments are coming in are made by mostly international companies like Microsoft, Amazon, etc., which have been used to using steel as their prime material for construction. So when these companies are setting up data centers over here, obviously that shift from concrete to steel is going to happen. But it is still a new field. Indian companies are also investing in data centers. This is just an example I'm giving you that newer applications are falling into place, which will also increase the demand of steel construction. So while capacities are being increased, there will be enough demand from existing application areas as well as the newer ones that are coming in.
Okay. So is there any internal, vision for next 5 years in terms of getting at the market share or the revenue that we are looking at?
Internal, okay. So we have a very clear-cut 3-year plan, and we are also very clear about 5 years. So in 3 years, we want to build up our PEB capacity between all the 3 plants. This is 3 to 4 years of vision document. We should be about 300,000 tons in terms of our capacity between the 3 plants over the next 3 to 4 years. And out of that, export should be minimum, I would say 20 to 25%, rest all will be domestic. And then Proflex, we want to maintain our predominant market share of 75%. And if the agri and railways, they accelerate, Proflex can be easily 2x. There's not a problem. But we'll have to wait and see.
Okay. That's all from my side. Best of luck, sir. Thank you.
Thank you.
Thank you. We'll take our next question from the line of Bhavya Deria from Chris. Please go ahead.
Hello, am I audible?
Yes, please go ahead.
Chirag, what is the split between Phoenix and Proflex for this quarter?
Yeah, I will tell you.
Revenue?
Yes.
Yeah, revenue.
So this quarter, Proflex has contributed 69.79 crore, whereas Phoenix 281.72 crores, making 351 crore.
Okay. And on our current order book, which is, I think, executable in the next 8 to 10 months, and also the current order bid pipeline, do we see there could be 100 to 200 basis points EBITDA margin expansion going ahead?
You're talking of this quarter?
No, current.
No. I am talking about next 1-2 years vision. Do we see a margin expansion, EBITDA margin expansion?
I would say around 1% is realistic over 1 year period, maybe, but 2% is a little more ambitious, given the current context. And given the fact that our product mix will continuously move in, but this is not a guidance, this is the general statement. We will come back to you with more specific numbers by Q4.
Okay. And the order that we recently won, the largest export order of 212 crores, what would be the margins in that? Like, what could be the margin profiles in it? In this order particularly?
We will not share order-wise margins, huh? Not correct. We will not.
Okay. Thank you.
Thank you. We'll take our next question from the line of Raj Saraf from Finvestors. Please go ahead.
Yeah. So if you can please quantify the order pipeline for export and domestic market with the order conversion rate.
Sorry, we didn't get you.
Raj, you want the pickup of order book?
Not order book, sir. Order pipeline. You already gone through the order book in the presentation.
No, very difficult.
I can just give you a general idea, Raj. Our order pipeline, see, currently we are handling inquiries worth about 17 to 18 lakh square meters in Proflex and about 100,000 active inquiries of about 100 to 150,000 metric tons in Phoenix.
Okay, so though you have repeatedly told that you will be very clear on Q4 about the number for FY27, but how a layman investor like me can just quantify, seeing the current capacity constant in short term, how FY27 number could be?
I think, Raj, we were pretty clear about the direction. I said we will be in upper teens in terms of growth, but we are working on quite a few projects and we will be a little more specific by end of Q4.
Okay. So just last question from my side, sir. As you know that the S2 is the strongest half. So if you can please be very specific about which is our strongest quarter. Is it Q3 or Q4?
Generally, it will be between Q3, Q4 because see, we have to deliver as per the project delivery schedules. But generally, you can say about 55 to 60% could be H2 and about 40-45% would be H1.
It will keep shifting between Q3 and Q4.
And the primary reason is again monsoon.
Yeah.
Okay. So we have seen, sir, monsoon in southern part in Q3, early Q3, I think.
Right.
Okay, so generally our PEB companies, peer companies are actually having great larger Q4 numbers in comparison to other quarters. So that's why I'm asking, seeing the last year Q3 Q4 numbers. So Q3 was the strongest quarter previous year. So how I can conclude this?
No, so there is no direct correlation, again as I said, but yes, this year Q4 would be quite strong in terms of top line, but stronger in terms of bottom line as compared to Q3, clearly.
Okay. Thank you very much, sir. Thank you very much. And I just wish you a good year ahead for FY27 and even beyond that. Thank you.
Thank you much.
Thank you.
Thank you. As there are no further questions from the participants, I now hand the conference over to management for closing comments. Over to you, sir.
Yeah, thank you everyone on behalf of the management of MNB Engineering Limited. We thank you all for joining us on our post-earnings call today. We hope we have been able to address majority of your queries. You may reach out to me or our investor relations partner ENY for any further queries that you may have, and they would connect with you offline. Moderator, we can now close the call. Thank you all.
Thank you, sir. Thank you, management team. On behalf of MNB Engineering Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.